If you're like us, as we round the corner into year end, we look forward to the holiday season and work begins to slow while we prepare to spend time with friends and family. But markets and economic data rarely follow suit. And this year, markets are active. Investors in U.S. equity indices especially have enjoyed relatively strong gains. Earlier this week, the U.S. Central Bank, the Federal Reserve, held its final scheduled monetary policy meeting of the year, and it delivered a positive pre-Christmas surprise to investors by suggesting that not only was it likely done raising its short-term interest rate targets, but also that it's more likely to begin cutting interest rate targets in 2024. This has lifted investor sentiment, or what we like to say, when strong market rallies continue, the market's animal spirits have been lifted. While the Fed is not the ultimate determinant of interest rates, its policies do influence the economy and market activities. And the Fed made it very clear this week that the level of inflation has retreated much more than it expected in 2023, and that both the labor market and economic growth have exceeded its expectations. 3 months back, more investors were concerned that the Fed would look to lower interest rates to stimulate a slowing economy, and now the view has evolved and the Fed can begin to lower interest rates because inflation trends are much lower. An important part of the S&P 500 equity gains in November and December this year has been broad participation. Many more companies and sectors have driven recent market gains compared to concentration in several of the very large market-leading companies earlier in the year. And that's healthy. While challenges remain as economic growth slows from this year's positive surprise, and interest rates are well above the very low levels of most of the past several years, the chances of avoiding a recession have improved. The timing of market rallies is hard to predict, and that's why we believe that long-term investors should remain invested in high-quality companies. We also believe that rebalancing portfolios is important as well, and especially after outsized market moves. This can include trimming positions that have moved well above target weights and adding to positions that may have lagged. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.